Before exploring the mechanics of long-term wealth accumulation, we must first address a fundamental constraint: systemic resilience. The most optimized investment strategy will fail if you are forced to liquidate positions prematurely due to external financial shocks. In academia and research, career paths are often characterized by non-linear income, contract-based employment, and geographic mobility. These variables, ranging from medical and family emergencies to relocation costs or visa-related legal expenses, represent a high probability of idiosyncratic risk. Without a dedicated liquidity buffer, these events necessitate high-interest borrowing, effectively negating any gains from your investment portfolio. This protocol addresses the design and implementation of an emergency fund, serving as a dedicated liquidity reserve to ensure system stability. An emergency fund is a risk mitigation tool designed to eliminate financial fragility. Without liquid capital, you are susceptible to a forced debt financing event. The objective is to decouple your essential survival costs from credit markets, preventing the compounding of high-interest debt that occurs when unplanned expenses are financed through credit. The standard heuristic is 3 to 6 months of non-discretionary living expenses. However, for the academic and scientific career trajectory, this must be treated as a transition cycle reserve. You must calibrate your buffer based on the specific volatility of your current phase. We are accounting for non-linear transition intervals such as the gap between PhD completion and a postdoctoral or industry position, the transition period between postdoctoral appointments and permanent faculty or R&D roles, the initial runway required if pursuing a startup or venture, funding latency for those in soft money positions where institutional support is contingent on grants, scheduled fallow periods, a strategic rest interval post-dissertation, which should be accounted for as a planned consumption phase. Your emergency fund is not just for emergencies, it is the capital runway that provides you the professional mobility to wait for the right career opportunity rather than being forced to accept the first available offer. The criteria for emergency assets are liquidity and capital preservation. Market-linked assets are unsuitable due to volatility. High-yield savings accounts, HYSA, or money market funds are the optimal vehicles. They provide instantaneous access while hedging against cash depreciation via interest without exposing the principal to market drawdown risk. Building this reserve does not require a large lump sum injection. The most sustainable approach is an automated incremental contribution, treated as a recurring line item in your monthly budget. The goal is to reach your target buffer through a steady state accumulation rate rather than unsustainable short-term austerity. Attempting to invest surplus capital before achieving liquidity leads to liquidation risk. If market cycles correlate with personal financial emergencies, you are forced to sell assets at a loss. Establishing this buffer creates a barrier layer that protects your long-term investment horizon from short-term volatility. To optimize your financial system, observe this hierarchical order of operations. 1. Stabilization. Eliminate high-interest liabilities. 2. Liquidity. Establish the risk mitigation buffer. 3. Growth. Initiate long-term, systematic market participation. In the next session, we will shift focus to the mechanics of long-term growth, specifically the architecture of broad market index funds and the principles of passive participation.